Welcome back to the Deep Dive. Today, we are taking a really granular look at the Q3 2025 earnings call for Ultrapar Participaes S.A.
Ticker UGP.
Exactly. And, this is a critical one because we're trying to solve a paradox.
It's a huge one.
A company that just completely smashed consensus on net income, delivered record cash flow, and executed these major strategic moves.
And then the stock just tanks.
Falls off a cliff. So our mission today is to really dissect what's going on under the hood.
Yeah, we need to separate the one-time wins from any, real structural improvements. We have to figure out what the market saw that made everyone run for the exits.
Despite these, sparkling top-line results.
They really were.
The call was November 13th, so for the NYSE-listed ADR, it was still pre-market.
Right, but the local B3 shares in Brazil were already trading mid-session.
Which explains that immediate, heavy reaction. So let's start with those financials, the numbers that made the headlines.
Okay, so they absolutely crushed it. Net income clocked in at our $772 million.
And the consensus was what, around our $500 million?
Just over. Our $508 million. So that's a massive, a 52% upside.
Wow.
This wasn't a small beat. It was the defining earnings per share blowout.
Okay, so it sounds like a company just firing on all cylinders. Was the revenue there to back it up?
The top line was solid. Maybe not as explosive as the bottom line, but solid. Net revenues hit our $32.98 billion.
Which is what, year over year?
That's a respectable 3% growth. But more importantly, adjusted EBITDA, that's the key profitability metric, right?
Right.
That was our $1.9 billion, a 27% increase.
Okay, but the real story, the one that should have had institutional investors thrilled, was the cash generation.
Oh, for sure. And the balance sheet.
Yeah, that's what I was going to say. The balance sheet strength, wasn't it?
Without a doubt. Operating cash flow nearly tripled to our $2.1 billion.
Tripled.
Yeah, and that's a direct result of just dramatically better working capital management. And they put it to use right away.
Deleveraging.
Exactly. Their net debt to EBITDA ratio dropped from 1.9 times last quarter down to a very healthy 1.7 times.
And that's even after paying out dividends.
Yep, even after distributing our $326 million in dividends back in August.
That kind of reduction is so critical, especially for a large Brazilian conglomerate. It gives them this defensive flexibility that, the market usually rewards heavily.
It should.
So we've got all the ingredients, right? A 52% EPS beat, huge cash flow, lower debt, and yet the UGP ADR closes down 4.2% on the day.
On massive volume.
Yeah.
Over 3.5 times its average. That is profound skepticism.
It is. So this is where we need to stop looking at the press release and, start digging into the footnotes.
Starting with the biggest piece of the pie, Ipiranga, the fuel distribution arm.
The engine room.
It is the engine room of Ultrapar. But this quarter, it sort of revealed a deep flaw in that engine's performance.
Okay, let's unpack this. Ipiranga's total reported EBITDA was $1.09 billion, up 12% year over year. That's a good number.
It looks like a good number.
But you're telling me it's misleading.
Completely. When you normalize it, when you strip out the non-recurring stuff, the recurring adjusted EBITDA for Ipiranga was actually down 5% year over year.
Down 5%?
The entire 12% growth was essentially smoke and mirrors.
And that smoke was, what, a one-off tax credit?
A big one. Somewhere between $185 million and our $238 million in extraordinary tax credits.
So the market in just a few hours basically just discounted that entire gain and focused on the fact that the underlying business, the fuel spreads, are still struggling.
Exactly. The core business is still fighting for structural margin. And this ties right into what management was saying about their strategy.
Right. They mentioned volume recovery after that Carbono Oculto operation.
Yeah, and they signaled they're prioritizing regaining lost market share, regaining scale, rather than just optimizing for short-term margins.
Okay, we need to pause on Carbono Oculto. For anyone less familiar with the Brazilian energy scene, this is, it's fundamental.
No, it's critical. Carbono Oculto, or hidden carbon, was this huge, ongoing government crackdown on illegal fuel practices.
And we're not talking small-time fraud.
No, this is sophisticated stuff. Tax evasion, selling illegally blended or just garbage fuel.
Yeah.
These fraudsters operate with margins that a compliant company like Ipiranga just can't touch.
Of course. Because if you're Ipiranga, you pay your taxes, you maintain quality. Your product is just inherently more expensive than the illegal stuff down the street.
Precisely. So management sees the success of this crackdown as a permanent leveling of the playing field.
If it's permanent.
That's the key. If enforcement sticks, the good guys gain structural margin over time. But the market's reaction, That 5% recurring drop, it tells you investors aren't convinced yet.
They don't trust that regulatory consistency in Brazil is a sure bet.
Not yet. It's a sharp insight. The market's basically saying, great quarter, but we don't trust the structural shift.
And while Ipiranga was dealing with that margin squeeze, the real stars were on the logistics side.
Yeah, that's where the story gets really compelling.
Let's talk about Hidrovias do Brazil, now fully consolidated into Ultrapar. This segment was a blockbuster.
Hidrovias, the river navigation arm, yeah. It was responsible for a huge chunk of the good news. Their recurring adjusted EBITDA was our $361 million.
Which is an incredible, what was it, 114% increase year over year?
114%. It was driven by normalized river conditions, especially in the South Corridor.
So, better weather.
Better weather, basically. It allowed for maximum efficiency and really high iron ore volumes.
Okay, massive growth, but it comes with a big asterisk, doesn't it? It's cyclical. You're completely dependent on weather patterns.
Absolutely. The market applauds the execution, but it does not see that 114% growth as repeatable next year.
No way.
And then you have Ultracargo, the terminals business, which had, let's say, a mixed quarter.
Their capacity was up, right, with the new Santos terminal?
Yeah, capacity up 3%.
Right.
But their Q3 EBITDA was down 20% year over year.
20% is a big drop for terminals business. What was behind that?
It was mainly decreased demand from customers for fuel import tanking services. It points to broader dynamics in the commodity market, probably related to Petrobras shifting its import strategy. Management says it'll recover in Q4 as that new Santos capacity ramps up, but it was a clear drag on the quarter.
And then there's Ultragas, the LPG segment. Volumes there were down about 6%.
Yeah, especially in the bulk segment, which points to softer industrial demand.
So is that just a macro indicator for the Brazilian economy, or is there more to it?
It's a bit of both, I think. Softer industrial demand is a macro signal, for sure. But Ultragas is also facing some really tough competition in the LPG market.
And the regulatory risk.
And the massive regulatory risk. That segment operates under a huge shadow of uncertainty.
Yes, the government's plans there are causing a lot of anxiety.
We're talking about this ongoing regulatory reform process, including social programs like Gas do Povo.
Right, gas for the people, which is basically a political initiative that could cap or subsidize LPG prices.
Exactly. And if that happens, it just crushes distribution margins and injects massive political risk into their pricing. The market hates that. We probably won't get clarity until the first half of 2026.
So looking at all these headwinds, across fuel and terminals, it's pretty clear management knew they needed structural solutions, not just cyclical luck.
For sure. And that brings us to the portfolio reshaping they announced. This is not the Ultrapar of 5 years ago.
No, they're sharpening their focus.
Precisely. Key move number one, selling Hidrovias' non-synergistic cabotage operation for about $115 million.
Shedding assets that just don't fit the core strategy.
Right. And then on the flip side, they're investing. They bought a 37.5% stake in Vertu, an LNG logistics firm.
For around our $102 million. Why is that LNG move so strategic?
Well, it signals a tangible bet on shifting toward higher growth, cleaner LNG value chains. It's a hedge away from the highly regulated pipeline gas and the bulky LPG business.
And they also doubled down on their core LPG position, didn't they? They got approval from CADE for that PSIM port terminal JV.
Yeah, with Supergasbras. So they're reinforcing their position in the critical LPG supply chain while simultaneously hedging their long-term risk with LNG. It's smart.
And all this discipline, they say, ties back to their Ultra Day 2025 commitment.
Management kept repeating their commitment to that 20% minimum return hurdle for all new projects.
That 20% hurdle sounds fantastic on a slide, but let's be realistic. Historically, large infrastructure projects in Brazil,
Especially with regulatory exposure.
they rarely clear that bar consistently. So are they setting a target they know they can't meet just to impress the market?
I think it's a bit of both. They are communicating capital discipline very, very loudly, but more practically, it's a commitment they have to answer to.
What do you mean?
If they can't find those 20% projects, they've already told us where the money is going. Back to shareholders.
And that really is the crux of the market's dilemma right now, isn't it? We have this undeniable execution, record cash flow, clear strategy.
And yet the stock dropped. The market was focusing less on the results and more on the sustainability of those results.
The bar was just set too high. I mean, the stock had outperformed the broader index by almost 40% year over year going into the call.
The market is demanding proof. Proof that this new diversified infrastructure platform can generate repeatable, high-quality returns without relying on one-off tax credits at Ipiranga Or a weather-dependent cyclical rebound at Hidrovias.
It's like they're discounting the future based on past volatility, and the regulatory risk just amplifies that. We have this powerful tailwind, the Carbono Occulto crackdown.
Which structurally benefits Ipiranga, correct, but that benefit is completely balanced out by the massive risk hanging over Ultragas from the LPG reform process.
And that potential for gas do Povo.
Right. So the market is pricing in regulatory risk over the operational execution. Ultrapar is trying to shift its story from a risky turnaround to a diversified infrastructure play, but it's still tethered to Brazil's unpredictable regulatory environment.
Which raises an interesting question. When the market gives you that kind of skepticism, despite record cash and lower debt, does that create an opportunity?
Which brings us to our segment.
This is not financial advice.
And of course, standard disclaimers apply. This is for informational purposes only. Do your own diligence.
Absolutely. But let's put on our most speculative analyst hats here. The trade pitch is simple, a UGP capital return play.
The whole argument rests on their capital allocation flexibility.
Right. They've tripled operating cash flow, leverage is down to 1.7x. They are just swimming in deployable capital.
And like we said, management has been explicit. If they can't find projects that meet that aggressive 20% return hurdle, they will increase the dividend.
A threat that's particularly potent right now, given all the talk about potential dividend tax changes in Brazil.
Which could incentivize them to pay out sooner rather than later.
That's the engine of the trade. The stock dropped, creating a discount. The idea is to buy the UGP ADR now. It was trading around US $4.11 post-call, and at the same time, sell put options below the current market price.
So you're betting that the floor price is supported not by operations alone, but by the very real, very explicit possibility of a big, maybe even accelerated dividend payout in Q4.
Exactly. That dividend acts like an unintended share buyback program, rewarding shareholders who bought the dip. The risk is regulatory disruption, for sure.
But the catalyst is capital distribution, driven by their own internal discipline. It's an aggressive but, plausible way to capture that cash flow before they're forced to either invest it or pay it out.
At the end of the day, the critical takeaway here is this. Ultrapar delivered on execution. They delivered on strategy. But the market has moved on.
The focus has shifted entirely from if they can execute to if they can repeat it without the help of one-offs or cyclical luck.
So here's the final thought for you to mull over. Does the ongoing government enforcement against fuel fraud, the success of Carbono Occulto, does it fundamentally and permanently change the competitive landscape for compliant distributors like Ipiranga? Does it make that underlying fuel business structurally more valuable?
Or is it just too early to rely on regulatory consistency in Brazil? That tension, I think, between the high operational potential and the constant political uncertainty is what defines this stock.
Thank you for joining us for this deep dive. And remember, this is for informational purposes only. We encourage you to continue exploring the complex interactions between corporate strategy and regulatory risk. We will catch you on the next deep dive.